DeFi sounds like another crypto buzzword, but what if I told you it's quietly reinventing banking and investing? In the next few minutes, you'll understand exactly what DeFi is, how it works, and why it's changing the future of finance. So, what is DeFi? DeFi stands for decentralized finance. At its core, it's about moving financial services, things like borrowing, lending, saving, and trading, away from traditional institutions like banks and replacing them with smart contracts running on blockchains. So instead of needing a bank to approve your loan, a DeFi platform like Aave uses code to automatically match borrowers and lenders. No forms, no credit checks, no middlemen. Instead of using a broker to trade crypto, you could go to a decentralized exchange like Uniswap, where your trade gets processed instantly by a smart contract. Again, without anyone holding your funds. And instead of a savings account at your local bank earning only 1% interest or even less, you can deposit your crypto into a DeFi protocol that pays you 5%, 10%, or more, depending on the platform and risk level. That's the big idea behind DeFi. It's open, it's global, and it works without asking permission. If you have a smartphone, internet access, and a crypto wallet, you can start using DeFi without a bank account, without government ID, and without waiting for business hours. So what can you actually do with DeFi? Well, let's go over the 4 most popular things people use DeFi for today. First, there's lending and borrowing. On platforms like Aave or Compound, you could lend your crypto and earn interest from borrowers. Or you can deposit your crypto as collateral and borrow stablecoins against it instantly. There's no human approval process. The smart contract does all the work. This is useful if you need liquidity but don't want to sell your long-term assets like Bitcoin or Ethereum. Second, there's decentralized exchanges, or DEXs. A decentralized exchange, or a DEX, lets you swap one crypto for another directly from your wallet. There's no account needed and no giving up control of your funds. Popular platforms like Uniswap and PancakeSwap use liquidity pools instead of order books. These pools are filled with crypto locked in smart contracts that handle trades automatically. Here's why that matters. On Coinbase, you rely on a company to hold your crypto and approve trades. On a DEX, you stay in control. There's no signups, no middlemen, and no risk of the platform freezing your funds. If you want to swap ETH for USDC, the smart contract finds the pool, calculates the rate, and completes the trade, all within seconds. It's fast, permissionless, and self-custodial, a key reason DEXs are at the heart of DeFi. Third, there's yield farming and liquidity mining. This is where things get a little more advanced. You can earn rewards by putting your crypto to work in different DeFi protocols. For example, by providing liquidity to a trading pair on a DEX or staking tokens in a yield farm. In return, you earn fees or extra tokens. The potential rewards are higher, but so are the risks. This is where many beginners get burned if they move too fast without understanding how it works. Fourth are stablecoins and synthetic assets. DeFi also gives you access to digital assets that are pegged to real-world assets like the US dollar or gold. A great example is DAI, a stablecoin that's managed by the MakerDAO protocol. It maintains its $1 value without relying on a central authority. There are also synthetic assets like stocks, commodities, or even indexes that you can trade on DeFi platforms using blockchain tokens that mirror their prices. So whether you want to save, trade, borrow, or experiment, DeFi gives you tools that feel familiar, but work in a completely different way. So how does DeFi actually work? Let's talk about what powers DeFi behind the scenes. It all comes down to smart contracts, self-executing programs that live on the blockchain. When you deposit funds into a DeFi protocol, you're interacting directly with one of these contracts. Most DeFi runs on the Ethereum blockchain, which is like the operating system for smart contracts. But there are newer platforms like Solana, Avalanche, Arbitrum, and Polygon are also growing fast because they offer faster transactions and lower fees. Another key piece of the puzzle is something called a liquidity pool. This is a big pot of crypto tokens that users contribute to. When someone wants to trade or borrow, they interact with the pool, not another individual. The incentive for users to add funds to the pool is simple. They get paid. Every time someone trades or borrows from the pool, a fee is paid. and part of that goes to the liquidity providers. Because there's no bank or company taking a cut, the profits go directly to the users who fund the system. It's a new kind of financial ecosystem, one that runs on code, not people. So why does DeFi matter so much? Here are 4 major reasons. First off, it gives financial access for everyone. In many parts of the world, people don't have access to reliable banks. DeFi lets anyone with internet access to use financial tools without paperwork or discrimination. Second, there's full transparency. Everything that happens on DeFi platforms is visible on the blockchain. You can see how the protocol works, how much is in it, and even audit the code yourself if you're technical. Third, there's no middlemen, so you have more control. You don't have to trust a third party to hold your money. You keep control of your wallet, your funds, and your decisions. And fourth is the innovation at lightning speed. Because it's built on open source code, DeFi protocols can evolve quickly. Developers all over the world build on top of each other's work. It's like stacking money Legos. And that's the power of DeFi. It gives you freedom, control, and opportunity, all without relying on traditional institutions. But there are some DeFi risks that beginners need to know about. So before you dive in, you need to understand that DeFi isn't risk-free. Here are the most common dangers. Smart contract bugs. If there's an error in the code, hackers can exploit it and drain millions. This has happened before, and it will happen again. So, only use platforms that have been audited and are trusted by the community. There's also rug pulls and scams. Some DeFi projects are created just to steal your money. They look legit, but the developers disappear with the funds. Stick to the major platforms with a proven track record. There's also impermanent loss. If you're providing liquidity and the price of your tokens change too much, you might lose value even if the protocol pays you rewards. There's also no customer support. So if something goes wrong, there's no number to call. It's on you to know what you're doing and double check everything. That alone is why I advise most crypto beginners to stay away from DeFi. It's super frustrating when you can't get any help on a DeFi platform. Another problem is regulatory uncertainty. Governments are still finding out how to handle DeFi, but future rules could impact how some platforms operate, especially in the US. In short, DeFi is powerful, but you need to treat it with respect. So that's your DeFi crash course. We covered what DeFi is, how it works, what you can do with it, and why it's such a big deal. Plus, the major risks that you need to look out for. If you found this helpful, hit like, tap subscribe, and drop your questions in the comments. And don't forget, the more you understand, the safer and smarter you'll be in crypto.